Running a venture capital firm is more than just making investments. It's about managing the fund itself as a business. While the goal of any VC firm is to generate strong returns for its investors, achieving that requires careful financial discipline, operational efficiency, and a clear strategy for balancing fund expenses with long-term performance. Unlike startups, which grow by reinvesting revenue, VC funds operate on a different financial structure. They are funded primarily by management fees and carried interest, both of which are tied to performance and investor commitments. This means fund managers must make every dollar count, ensuring that resources are allocated wisely while still maintaining the infrastructure necessary to support portfolio companies and source high-quality deals. For both emerging and established venture firms, balancing operational costs and investment performance is critical. Overspending can erode returns, while underinvesting in key functions can limit a fund's ability to compete for the best deals and provide real value to LPs. The core of fund management is understanding where capital is allocated. A VC firm's primary expenses include investment-related costs such as due diligence, legal fees for term sheets and deal structuring, industry research, and travel to meet founders and attend industry events. Operational overhead covers salaries for investment and operations teams, office space, technology infrastructure, fund administration, and compliance costs. Additionally, LP and fundraising expenses include regular investor reporting, annual meetings, relationship management, and travel to secure new LPs for future funds. Most funds operate on a 2% management fee, meaning that for a $100 million fund, the annual budget is $2 million. While this may seem like a large amount, a mismanaged budget can quickly strain resources, especially for emerging managers who need to establish credibility, manage a lean team, and handle the complexities of fund administration without the scale of a larger firm. Larger funds managing over $500 million in AUM have more flexibility, as they can spread costs across multiple funds and a larger team. However, for first-time fund managers, careful budgeting is essential to ensure that resources last across the fund's life cycle, typically 10 years. A venture fund is only as strong as its team. Hiring too aggressively early on can lead to unnecessary costs, while operating with too small a team can slow decision-making and deal execution. For emerging managers, the first hires are critical. While large firms can afford full deal teams and support staff, newer funds must balance key roles. Investment professionals, including analysts, associates, or principals, form a lean team to support deal sourcing and due diligence. Operations and finance functions are typically handled by fund administrators and legal counsel to manage reporting, tax compliance, and fund structures. Some funds also engage venture partners or advisors who provide domain expertise on a part-time basis without the full-time cost burden. To further control costs, some firms use outsourced fund administration services instead of hiring an in-house CFO, keeping fixed expenses lower while ensuring compliance and financial oversight. A common mistake among first-time fund managers is deploying capital too quickly or too slowly. Some funds rush into early deals, leaving too little capital for follow-on rounds and reducing their ability to support winning startups over time. Others hesitate too much, waiting too long for the perfect investments, making it harder to return capital within the fund's life cycle. A typical VC fund deploys 40 to 50% of its capital within the first 3 years, keeping the remainder reserved for follow-on investments in high-performing startups. The key is balancing initial investments with reserves to ensure that when portfolio companies need additional funding, the fund can continue backing its winners rather than being diluted by external investors. Many top-tier firms reserve 50 to 60% of their capital for follow-on investments, ensuring continued support for their strongest companies through multiple rounds. For example, a $100 million fund might make 20 to 30 initial investments, with $2 million to $5 million allocated per company. Among these, only a handful will emerge as breakout winners, so the fund reserves additional capital for follow-on rounds to maintain ownership in its best-performing companies. Funds that fail to plan for follow-on investments risk missing out on their best opportunities, as external investors may step in to take larger stakes in the most promising startup. A well-run VC fund is not just about making good investments, it's about keeping LPs informed and engaged. Managing investor relationships requires structured, transparent reporting on fund performance, capital deployment, and portfolio updates. LPs expect regular communication, including quarterly updates summarizing fund performance, major portfolio developments, and any shifts in strategy. Annual reports provide more detailed financial breakdowns, covering valuations, projected exits, and capital reserves. AGMs offer direct engagement with LPs, giving them the opportunity to ask questions, meet portfolio founders, and assess fund strategy. Managing LP relationships is an operational cost that pays off in future fundraising cycles. LPs who feel informed and confident in a fund's management are more likely to reinvest in future funds, creating a sustainable flywheel for the VC firm. For emerging fund managers, the challenge is keeping operational costs low while still competing at a high level. Optimizing efficiency involves leveraging technology through data platforms like PitchBook, CB Insights, and Carta to streamline deal sourcing and cap table management. Many smaller funds reduce expenses by outsourcing fund administration, working with third-party providers for financial reporting, compliance, and LP management instead of hiring a full-time CFO. To minimize overhead, first-time funds often operate remotely or use shared workspaces rather than leasing expensive offices. Travel is another area where strategic planning matters, as excessive spending on unnecessary trips and events can drain a fund's budget. At the same time, some costs should never be cut. Strong legal counsel, due diligence processes, and LP communications are non-negotiable. Cutting corners in these areas can lead to legal risks, poor investments, and strained investor relationships. A venture fund is not just a one-time vehicle, it is meant to be the foundation for future funds. Managing capital wisely ensures that fund managers can prove their ability to deliver returns and successfully raise follow-on funds. This requires carefully tracking fund performance, maintaining a clear picture of IRR and portfolio growth, which is essential for future fundraising. A strong reserve strategy for carry is also crucial, as successful funds eventually generate carried interest, typically 20% of fund profits, though it takes years to materialize. Diversifying income sources can further strengthen financial stability, with some firms launching sidecar funds, SPVs, or advisory services to create additional revenue streams between fund cycles. For emerging managers, the first fund is about proving discipline, execution, and responsible fund management. Investors assess not only how well the fund performs, but also how efficiently it is managed operationally. A well-balanced approach, where costs are controlled, LPs are engaged, and capital is deployed strategically, lays the foundation for a long-term, scalable venture firm. Success in venture capital is not just about writing checks. It is about building a firm that thrives across multiple cycles, adapting and growing with the market.